Welcome to this week's market commentary, and today I really want to focus on something that's been taken over the media headlines, and that is the failure of the Silicon Valley Bank, the 16th largest banking institution in the United States. And its significance is important because it has generated a lot of uncertainty as to kind of what it means for other banking institutions and the viability of the banking system. And I really want to address those because we're releasing a 4-page commentary, more of a small research piece, so to speak, that outlines all of the reasons why the bank failed, how it happened, and the underlying objective nature of why we believe this failure does not pose any systematic risk to the banking institution whatsoever. And we start that analysis by just pretty much talking about the fact that, bank failures are not uncommon. What is uncommon, however, is with a bank like the Silicon Valley Bank with $209 billion in assets failing in a matter of 48 hours. And the reason that's important, the reason it's generated so many issues across potential issues, or perceived issues, is because post the Great Financial Crisis, right, when we had roughly 300 or 320 bank failures between the 2008 to 2009 timeframe, the regulatory environment that emerged after that was designed to prevent things like this from happening, mainly referred to as the Dodd-Frank Act. And one of the questions that's been arising here recently is, did regulators truly miss blatant red flags prior to the collapse of Silicon Valley Bank, right? Could they have protected depositors, borrowers, investors, equity, and bondholders? Could they have protected them from what happened here in the previous week? And the reality is that objectively, the answer is no. The regulators did everything they objectively had to do under a bank's requirements, being below $250 billion in assets, right? The requirements for those banks are different for disclosures and stress tests, both external and internal, relative to those banks above the $250 billion in assets, right? Those banks fall in the category of systemically important financial institutions, or kind of SIFIs. So when we went back and looked at the requirements of Silicon Valley Bank from a capital ratio requirement on reserves, capital ratio requirement on equity holdings, all of the underlying components that would trigger the Federal Reserve to gauge the overall health of the Silicon Valley Bank, nothing stood out historically that would have generated red flags. When digging deeper into the bank's operations, however, right, and again, the paper outlines all of these components. When we dig deeper into it and ask the question, then why did this bank fail? How could a $209 billion bank in assets fail in a matter of 48 hours? The reality is that it focuses on two critical components. And number one, we have dubbed as poor management of loans, deposits within a homogeneous industry group, and we'll cover that. And secondly, the broader rising interest rate environment did have a negative impact. But I think blaming the interest rate environment, higher rates, for the bank's failure is the wrong conclusion. It's simply a consequence of kind of what we've seen happening in the industry. And one of the things to point out is, unlike a lot of the larger banks, think of your JP Morgans, your Bank of America, your Citigroup, your Wells Fargo banks, those individual banks, their 5-year loan growth rate has been roughly around that 10 to 12% mark, where Silicon Valley Bank's 5-year loan growth rate surpassed 200%. Now, there's nothing wrong with loan growth rate at those levels, but the risk management that should have been implemented in place should have been outside of just two main industries. This particular bank focused solely on the startups in the technology sector for the vast majority of their loans, whereas the rest of their loans were also very technology heavy. In fact, 50% of their loans, as of the latest filing, which came out in the third quarter of 2022, by the way, were concentrated in startups, 45%, with another 30% on top of that being concentrated in additional technology companies outside of the startup phase. There's nothing necessarily wrong with that. However, when you break down and segment the depositors of their assets, they were also the same industries, the same groups. The loan base and the deposit base was the identical across the board, right? Identical people, identical companies. The diversification, right? Such homogenous nature on that the lack of diversification, rather, did cause some serious issues as rates started to rise. And banks operate on a lot of liquidity, right? Liquidity needs of banks are very important. That treasury management, as rates rose, they were sitting on a bunch of losses on their balance sheet. And as certain venture capital firms, right, venture capital firms that own a lot of these startups, have invested in these startups, once that got word out that the bank may not be liquid enough, they started urging their companies to take their cash out of the Silicon Valley Bank. That, by definition, is a run on the bank. So on Wednesday morning, March 8th, as that started to occur, word got out, equity markets took hold of it, the stock corrected by 60%, the bank came out and said they had to raise $2.25 billion in order to remain solvent, and the rest, as they say, is history. It spiraled very, very quickly at that point. That's the overall 10,000-foot view of kind of what happened to the bank. And from a regulation standpoint, right, could regulators have done more in the interim? The answer is no, not much, because what we do know is that depositors are insured, rather, right? Accounts below or at $250,000, everyone has access to their money. No harm, no foul for the depositors. We now know that those uninsured deposits above the $250,000 mark, those will also be made whole by the federal government. President Joe Biden was out actually Sunday and Monday, following the bank's failure, addressing that those deposits would be made whole. This is a fairly positive. So then at the end of the day, the only people that are truly scarred, are truly impacted by the failure of the Silicon Valley Bank are the ones owning the stock, which unfortunately have lost their assets, as well as the bondholders, right? Great lesson in over-concentration and why investors should not over-concentrate to one stock, good or bad. As we look at this from a broader standpoint, one question we're getting is, are other banks at risk? It's critical to point out and to really be vocal about this, that systemically financial important institutions, your largest banks that run the country, right, in the trillions of dollars of deposits, they are not at risk. They are not invested, they're not, their deposit base and their loan base is not just one or two industries. They have significantly higher disclosure requirements, both internally and externally, relative to smaller banks below $250 billion. In fact, pre-2018, one of the requirements that banks like Silicon Valley Bank had to produce was an internal stress test on fleeing deposits. How would they react? How would the stock react? What would happen to their investor base, to their loan base, to their borrowers, depositors? However, post-2018, some of those laws changed. Disclosure requirements got a little more loose, and there was no such internal reporting of those underlying disclosures. We think that's likely to change. President Biden has already introduced that to Congress on various banking committees to start reintroducing those disclosures. But again, that's just there to say that larger banks, systemically important banks, have to disclose all of that in a very, very granular approach. And we don't believe they are at any form of systematic risk to consumers, borrowers, and lenders.